crashes happen. The dot-com bubble, 2008, COVID, pick a year, and there's probably a crisis behind it. And yet, every time the market drops, investors act surprised. Like they didn't know volatility was part of the deal. But here's the truth. It's not the crashes that destroy portfolios. It's the reaction to them. So, what if you had a portfolio that didn't try to predict the next crash, but survive it? A strategy built not for maximum gains, but for maximum resilience. That's exactly what Harry Browne set out to build in the 1980s. He called it the permanent portfolio. Harry wasn't a hedge fund guy. He was an author, a political thinker, and an economist who believed in individual freedom and financial independence. He saw how unpredictable markets were and how average investors constantly lost money by chasing trends. So he asked a simple question: what kind of portfolio could survive any economic condition? Browne identified 4 economic seasons: prosperity, when businesses grow and stocks thrive; inflation, when prices rise and currencies lose value; recession or deflation, when spending slows and interest rates fall; panic or uncertainty, when people flee to safety. He wanted to design something that would have at least one winner in every season. Here's what he built: 25% stocks. For growth during prosperity, 25% long-term government bonds, which rise when interest rates drop in recessions or deflation; 25% gold, a store of value during inflation or currency debasement; 25% cash or short-term bonds, for stability, liquidity, and buying power. It's symmetrical, it's simple, and it works. Because it's not built on forecasts. It is built on balance. When stocks are falling, gold or bonds might be rising. When everything's chaotic, cash gives you options. You're never 100% exposed to any one scenario, and that's the whole point. Let's talk numbers. Between 1987 and today, the permanent portfolio has averaged 6 to 8% annual returns, with very low volatility and shallow drawdowns. For example, in 2008, the S&P 500 dropped over 37%. The permanent portfolio, around 8%. In 2001 to 2002, during the tech crash, stocks tanked, but gold and bonds held up, softening the blow. Even in 2022, when both stocks and bonds fell together, the portfolio declined far less than traditional 60-40 mixes. And that brings us to an important comparison: the classic 60-40 portfolio. For decades, financial advisors recommended 60% stocks and 40% bonds as the balanced strategy. But here's the catch: that model assumes stocks and bonds move in opposite directions. And in a world of inflation, rising rates, and global instability, that assumption breaks down. In 2022, for example, both stocks and bonds crashed together. 60-40 portfolios saw their worst year in decades. Meanwhile, permanent portfolio investors, smaller losses, less stress, because they weren't depending on just 2 levers. They had 4. Another powerful feature: rebalancing. When one asset rises, you trim it. When another falls, you buy it. No emotions, no guesswork, just discipline. It's like gardening. You don't uproot the tree every time a storm hits. You trim the branches, you water the roots, and you trust the system. And maybe most importantly, it protects you from yourself. The average investor underperforms their own investments by 2 to 4% annually. Why? Because fear and greed make terrible investment advisors. Permanent portfolio investors don't need to decide what to do. The portfolio decides for them. You don't need CNBC, you need conviction. Now, let's be clear. This isn't a get-rich-fast strategy. It's a don't-go-broke-slow strategy. It won't beat the NASDAQ in bull markets, but it also won't leave you sleepless during the next crash. And if you want a little more growth, let's talk about the golden butterfly. The golden butterfly takes Harry Browne's logic and tweaks it for long-term accumulation. 40% stocks, split evenly between total market and small cap value; 20% long-term bonds; 20% gold; 20% short-term bonds or cash. The idea? Tilt a bit more toward growth while keeping the same anti-crisis defense. Historically, it's outperformed the 60-40 portfolio with less risk. Then there's risk parity, a strategy used by institutions like Ray Dalio's Bridgewater. Instead of splitting money evenly, it splits risk evenly. That means lower risk assets, like bonds, get more weight because they move less. Higher risk assets, like stocks or commodities, get less weight. It's more complex, but the philosophy is the same. Don't build a portfolio for the world you expect. Build one that survives the world you don't. So what can you learn from all this? Maybe you don't want to use the permanent portfolio exactly. Maybe you're young and want more growth. Or you already have exposure to real estate or crypto. That's fine. But the principles still apply. Diversify not just by asset, but by economic condition. Avoid overconfidence in a single outcome. Stay invested, not reactive. Because here's the real lesson. Most people build portfolios for sunshine. Smart investors build for storms. They don't try to time the rain. They just carry an umbrella. And in the investing world, umbrellas aren't weakness. They're wisdom. When the next crash hits, and it will, ask yourself, is your portfolio fast or is it durable? Is it built to thrive or built to survive? Because success isn't about chasing highs. It's about avoiding ruin. The permanent portfolio may not be exciting, but it's alive. And that's more than most portfolios can say after a financial crisis. In a world full of surprises, resilience wins every single time.